everyone. Today, we're going to talk about, is it a really good financial decision to buy now? Check this out. With rates at 7%, good things coming.
Most people think that buying a home at a 7% mortgage rate is crazy. But what if I told you it might actually be the smartest move that you can make? At the moment, a lot of people are hitting the pause button when it comes to buying a home, thinking, I'll just wait until mortgage rates come down. But what if that strategy ends up costing you more money in the long run?
What if it does? Now, I like what he started out here with this, and some people want to wait is very true. But buying now, I'm agreeing so far with what he's having to say, and I've got to spin on what to do, the difference between the 7% and what's going to come next. Let's roll this.
This video, you'll understand why locking in now could be a financially sound decision and why waiting might end up costing you more than you think. At the time we're filming this video, mortgage rates are sitting around 7%. And the problem is a lot of buyers out there are comparing them to the ultra low pandemic rates. But if we're being honest, those were somewhat of an anomaly. In fact, if we take a look at this chart here, you can see that 7% isn't really that unusual. And in the 1980s, interest rates were as high as 18%. I mean, even
hold that right there. Could you imagine that? Now, I've been doing this since the early 2000s, before the crash. And rates at that time, when I first started, were 5%. They went to 6, they went to 7. So I've lived in the 7% mark, and a ton of people purchased homes at that time. So those pandemic rates were a complete anomaly. I think we may see some good rates again, but this is absolutely spot on, and I want you to listen to more of what he has to say.
Early 2000s, 7% was normal. In fact, I drew a line going all the way across this chart at 7%. And you can see from that line, it's somewhat normal to be hovering around that number. Up until 2022, interest rates were in a 40-year bull market headed lower. But since that time, we've actually broken that trend. And as you can see from this chart here, we actually have more room to run on the upside than we do to the downside. Now, I don't want to set the wrong precedent in this video because I do believe that lower mortgage rates are coming in the future. But if you've been watching my videos over the last couple of years, I've been one of those people thinking that that year would bring lower mortgage rates, only to be wrong. And that's because mortgage rates are based on more than just inflation. While inflation
that is correct. Let's stop here for a little bit. Now, I myself thought that 2025 was going to bring a nice drop in these interest rates. However, with everything going on politically and the tariffs coming into place, it has kind of stopped what's going on in the market and the drop of things. However, we still can't predict. This is unprecedented territory coming into where we're at. I agree with now buying is a great thing. And one thing that's not being mentioned, though, lenders have a 1% discount point built into every loan cost estimate somewhere. Not all, a majority do. If you've got a rate, anything from the high 6s to low 7s, more than likely you're paying to keep that rate. Actually, rates are closer to 8% right now. And a discount point, if you don't know what that is, that's when you're paying money to buy a rate down. A discount point, a point is equal to 1%. So if you're buying a 1-point rate, it means 1% down. However, I've been doing this, like I said, a long time, a couple decades plus here, and never has it been affordable to charge 1% discount point and make it worth doing. Because right now you can actually buy down with 1%, give or take, 0.5 to 0.75% of interest rate. In other words, if your rate is 7%, real rates are probably between 7.5 and 7.75. Can you believe that? Yeah. I mean, they're talking about rates hovering at 7, but actually that's not 100% correct on where they're really at. That's where the market perception has them. Interest rates actually are a little higher than that right now. All the lenders, us mortgage banks, have put discount percentage points in there. And everyone now is used to paying a little bit more. So it's actually a really good thing psychologically to keep you at a lower rate, but allow you also to spend the money you want to spend on a house and get close or into that price range you're going to get into. I want to listen a little bit further, and I've got some more things to say.
Only to be wrong. And that's because mortgage rates are based on more than just inflation. While inflation has been coming down, the job market has remained really, really strong, even with the Fed's really restrictive stance, which in turn has given the Fed a reason to pause, to more or less back off these Fed rate cuts, which has kind of paused mortgage rates from moving lower and kind of kept them in between the 6.75 and 7.25 range. And while the government's debt continues to go more and more out of control, and the interest payments on that debt continue to go higher and higher, it looks like the Fed isn't going to allow mortgage rates to go much lower without actually seeing a break in the employment numbers.
There's a couple things I want to point out. This is huge. Public perception has just been absolutely wrong on this. Fed rates do not lower mortgage rates when they're cut. Let me run that back by this again. Fed rates are short-term interest rates that they're cutting. What we deal in as mortgage people is long-term fixed rates, long-term interest rates. They are not even related. Can they affect each other? Yes. I've seen the Feds raise the Fed rate and mortgage rates have actually went down. And I've seen the opposite too. They're not really related. Does the market perception kind of bounce off? Yes. Just like if you've ever heard this, the 10-year Treasury up and down helps dictate interest rates. However, they are no longer tied together like they used to be. If the Treasury moves, typically rates move as well, but they're not tied together. The Fed rates were never tied to long-term mortgage interest rates. So keep that in mind when we're talking about this. I love what this guy's having to say in the graphs. It's great information, and it's true for the most part. Here's something else, a little tidbit I'm going to give you about what's going on today. If you buy today at 7%, think about this. You buy today at 7%. It's going to cut into the affordability you want for the payment for the price that you're getting. However, my estimation, crystal ball speculation, I think a lot of people will agree with me, in the next 2 or 3 years, rates are going to come down. I believe if tariffs had not have happened, they would already be coming down in the end of the third quarter, which is only a couple months away. Now with those going on and us playing a game of chicken with the rest of the world, who's going to blink first? When everything calms down with all of that, rates will potentially continue their run that they were going to have, the trend they were going to have, and I believe that trend was going to put them down. 2 years from now, let's say they go down. You're in a 7% rate right now. If they go down to 5% on a $300,000 house, that could save you $250 to $325 on your payment. Now think about this, okay? Think about this. You're fighting to get the price you want for the payment you can afford. That's the problem we're having with these 7% interest rates for most people. Like, dang, I can't get the house that I want because the payment's, a couple $100 higher than I thought it was. Think about this. And you buying the house you want with the payment you want is what we want as well. Think about this. Every 10 grand that you raise that price raises your payment $70. Okay? So if you're wanting to get an extra $30,000 worth of home because what you're finding out there isn't getting you what you want for the payment you want, you're looking at about $200 to $220 a month extra. Now, what did I just say about interest rates in the next couple of years? Interest rates, we're predicting they come down. If you can tighten your belt and get with someone in the loan business that can run numbers for you and potentially help you gain cash flow on your bottom line by overviewing your financial situation when you're buying a home, you may be able to afford that higher payment for a short period of time, 2 to 3 years. And when you refinance, it's going to put you right in your sweet spot. Not to mention, when rates go down, guess what equity is going to do on the home that you just bought? It's going to go up. It's going to go up. A few months into those rate drops, people are going to come out in the droves to buy a house again because rates are in a great place and they've been holding out thinking that's the best thing to do. You've got to date that rate. Marry the house, date the rate. You can get rid of that rate later. You married the house. You're set. You have what you want. This is just a suggestion for you to be able to afford more of a house and to buy now versus later. And that equity position that could come when rates drop is more of an incentive for you to want to buy now. They say that in a down or bad market, those with money win because everything is for sale. Well, right now, houses being where they're at, prices have went kind of just stabilized. They're not going up. In fact, if anything, they're settling a little bit, but they're not going to crash. They're just kind of settling a little bit. And sellers are like, there's no feeding frenzy anymore. I may have to make a little more fair of a price out there or pay the buyers some costs to get them into this house. There's not as many buyers out there. My house is sitting more than 5 days, more than a half a day before we get an offer. The average price selling of home time has lengthened as we've gotten along with these rates. So right now, this is your time to buy. And the one thing to consider, and get with a knowledgeable loan officer like myself, who's a numbers person who can help you run those numbers and look at your whole financial picture so that you can create potential monthly cash flow room in your budget to be able to buy a little bit more house if you're not finding what you want. If you're finding what you want, hey, pop that sucker. Let's get you in there at the 7% interest rates. You're going to be so happy when things happen a couple years from now. So is buying a house now at 7% one of the smartest fiscal decisions you can make on your housing? 100%, in my opinion. I totally agree with this guy about that. I totally agree. In my professional opinion, that's what you've got to do. So get out there. Let's get you pre-qualified. Let's overview your finances. Let's find some place where you can cut and maybe pay something off and create cash flow and monthly room for you to be able to afford the house that you want right now, so that when rates go down, your equity goes up, you're dropping money off of that payment. Stay tuned for more great house buying tips and how to make money work better for you in buying your home right here, Kansas Loan Man. Talk to you soon. Hey, if you enjoyed today's video, you're going to enjoy the next one's coming too. Click here. Pow.